Hi everyone, it's Alex here at Sestring Capital Research. Welcome to our weekly webinar for the Growth Investor Pro service. It's currently Thursday, the 15th of May, just after 4:15 Eastern for the benefit of the tape. Okay, we want to spend some time on a particular topic today, which is leveraged ETFs. So lots of discussion on that in chat this week. And I'd like to cover some of the ground with those so that people understand what they are, where they can be useful, and how they can harm you if you let them. After we've done that, and I imagine there'll be a few questions on that, we'll do a usual market overview. We'll look at the S&P, the NASDAQ, we'll look at bonds and the TLT, Bitcoin and semiconductors as risk canaries. I'll talk a little bit about May options expiry, which is tomorrow. And then if there's time, and we'll probably be a bit tight today, we'll dive into some single name stocks. So in sort of chronological order as received, Pins Adobe, so Pinterest Adobe, Intel, XLV, XLE, the sector ETFs, and then a handful of semiconductor stocks plus Meta Platforms and Robinhood. Live as always, so if you have questions, comments, points, anything at all, please do shout. In a moment, after I've done the disclaimer, we'll open the mics in the system so you can just shout into the platform. Alternatively, if you don't like to use audio or you're not able to right now, then you can just post questions in the comments or the questions section of the webinar platform here. Okay, so let's get going. On your screen now is our disclaimer. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Sestring Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Sestring Capital Research. Sestring Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's get microphones on. Okay, mic's on. Right, let's get started. Let's talk about leveraged ETFs. So these were once a niche product, now much more common amongst investors, both professional and non-professional investors. And let's just take a look and do something that hardly anyone ever does, which is let's look at the actual fund descriptions for one of these things. Okay, this is TQQQ. It's a fund that's operated by ProShares, which is a established, specialized ETF fund manager. And if you spend some time looking at what the fund actually does, then the fund manager will tell you what it's there for, how it should be used in the fund manager's mind, what the risks are, and so on. Now, most people don't bother to do this because they don't want to put the time in. They think that leverage is a way to make easy money, which of course it can be under some circumstances, but it can be a way to wreck your account and others. And I would recommend that the very first thing you should do if you're interested in leverage ETFs is go and look at the fund manager's website and actually read the documents. Read what the website says about it, read the actual fund documents, read the risk sections, and actually take some time to understand what you actually buy. Because any ETF is not like owning a common stock, and a leveraged ETF is certainly not like owning a common stock. So that's the very first thing I would do. That'll take you a couple of hours per fund probably, and you might not want to do that, but frankly, that's effort that you should want to put in if you are going to use these things. We can look as well at what they actually do. Okay, so TQQQ, for instance, is a so-called 3 times levered NASDAQ 100 fund. But what does that mean? Okay, well, the headline, it means that if the NASDAQ, you've got the QQQ here, if the QQQ moves up by 1% in a trading day, then TQQQ will move up by approximately 3%. If QQQ moves up by 0.5% in one trading day, then TQQQ will move up by approximately 1.5%. If QQQ falls by 2% in any given day, then TQQQ will fall by approximately 6%. Now, you'll see the funds described as daily targets, and they don't always hit exactly the 3x, and that's because of what's in the fund. You know, what of counterparty agreements and other things are a basket of relative
Alex,
daily
Alex,
fund.
your voice is breaking. I'm not sure if I'm the only one, but
Alex, we can't hear you. You're breaking up.
Okay, all right, 1 second. Let me see if I can fix audio. 1 second. Okay, how's that?
You need to talk. We don't know.
Okay, how's that? Any better?
Yeah, now it sounds better.
Okay, all right. Okay, let's keep going. Okay, where did I drop off? What's the last thing that was clear?
It was like do. So,
Well, that's just what I normally sound like, so that doesn't.
yeah.
You were talking about the daily, how they manage each day and why each day might not be exact.
Okay, all right. Okay, so if you look inside one of these ETFs, okay, let's go to the Seeking Alpha page. Okay, and let's look at TQQQ and look at the holdings. Okay. So first of all, the holdings include things like treasury bills, a small amount of stocks, and then a bunch of other stuff representing more than 50% of the fund. And you will see, if we look at the fund managers page, this is boring, but you've got to do this. Hang on. Okay, this is the bit to look at. Look, so large percentages of the fund, okay, are not stocks at all. They're swap agreements, okay, and so these are basically interbank agreements, and they are purely synthetic matters, and they are there to cook up a recipe of stuff that approximates to 3 times the daily return of the QQQ. Okay, and you can see from the complexity of the holdings here, you don't need to know much about anything to look at that and go, that's quite complicated and weird, and isn't a very simple thing to own. So the first thing is if you're interested in owning levered ETFs, it's not a simple instrument. It's something that would typically be called a complex instrument. And complex instruments are usually for experienced investors only to deal with, because under calm market conditions, they usually do more or less what they say. Under extreme market conditions, complex instruments tend to hit problems much faster than common stocks, for instance. So first of all, know what you own. Okay, now back to this performance. So we talked just now about the fact that if the QQQ goes up by a point in a day, TQQQ will go up by 3 points, thereabouts. That's by design. The issue comes when the market chops around, or whether you get a really sustained decline. So let's look at, for instance, this is the all-time high for the Nasdaq, 19th of February. QQQ was at 540, and this is the recent low, the tariff lows, and QQQ was at 402. So if we do just a very simple sum, we can say that, okay, well, how much was the drop? So it dropped, let's call it 402 divided by 540. So it's about a 20, let's call it 25% drop. Okay. If we look at TQQQ, if you own TQQQ on the way down, then you started at 91 and you finished at 35. So you had about a 61, 62% drop. Now, first of all, notice that there isn't a 3 times multiple in there. It's just a completely different number altogether. It's obviously a much more brutal drop than QQQ because of the leverage, but it's not 3 times. The 3 times target applies only on a daily basis. TQQQ is a tremendous instrument to own during a smooth up market. So if you looked back here, let's do this for the QQQ. Let's go back to the bear market lows here, and let's say that at the end of December, QQQ was 258, and we'd already said that the peak was 540. So 540 on 258, about a 100% gain, let's call it. TQQQ though went from 16 to 93. So 93 on 16, let's call it almost a 6 times return. So when markets are fairly smooth and up, levered ETFs can be great things to own on a long-term basis. That's completely counter to how the funds are marketed. And it involves holding through fairly, vomit-inducing sell-offs. But if you get your timing right and you call a major market move over a period of years, then these things can be very rewarding to hold, albeit at the expense of big volatility. If you have the misfortune to hold them unhedged, no stop loss through a market sell-off, they're going to hurt. And something that people get themselves all bent out of shape over, but it doesn't trouble me personally, is, well, what happens if the market moves sideways in a sort of a choppy fashion? Well, the answer is they can decline even if the underlying is flat, because again, think how the daily leverage works. You're up a bit here, down a bit there, down a bit there, up a bit here, down a bit. And you can see how 3 times daily moves are not going to translate to a flat performance, but something else entirely. So my own view is, if you're going to use the leverage ETFs, then I believe you have to understand how to hedge with them. Or to put it another way, you have to really have a good fix on risk management. So it's fine, I think, to say, well, I'm going to take a bet that this October 23 low is a major low in the NASDAQ, and I'm going to buy TQQQ and I'm going to hold it. Okay. But you also know that if the NASDAQ slips, you're going to get beaten up badly by TQQQ. And so prudence would say either learn to hedge, we'll talk about that in a moment, or at least use a trailing stop. You probably need to have a fairly big trailing stop of 10 or 15%, because you can get 10% movements on a daily basis in a 3 times levered NASDAQ ETF, because sometimes the NASDAQ moves 3%. You can also decide to use a less levered instrument. So QLD is a 2 times levered instrument, for instance. You still get significantly more upside over a sustained bull move in the NASDAQ than you would by just holding QQQ, but you don't get quite as much brutal downside as TQQQ. The other way to do risk management, and it's a superior method in my opinion, but it's very difficult to do. And if you're going to do this, you have to really commit to learning how to do it, is to learn to hedge. And you can do that using the inverse ETFs. Now, just on a purely unlevered basis, you could use, say, QQQ on the long side and PSQ, which is a 1 times unlevered inverse version of the NASDAQ. So QQQ, if the NASDAQ is up 1% in a day, the NASDAQ 100 is up 1% today, QQQ will be up 1%. PSQ will be down 1% that day. If the NASDAQ 100 drops 1%, QQQ will be down 1% that day, but PSQ will be up. So where you can use that is, first of all, you have to learn to chart. Okay, it's not easy, but you have to learn to work out roughly where market peaks and troughs are going to fall. And let's say you thought that this was the low, this 7th of April, lots of evidence as to why it was. And you said, well, I know that if we get a wave one up here, we'll probably get a retrace. It'll probably drop to the 61.8 or maybe the 78.6, and then it'll probably bounce. So I think you might take this view. I think this might be a good place to enter a long position here. So you might decide to buy TQQQ here. You might say, well, I think we're going to wave 3 up. And then what you might say is, as the wave 3 moved up, is you might say, well, I'm a bit worried about this 200-day here. Okay, seems to have got over it all right. But look, I'm approaching the 1.618 extension. So I know that there's a good chance that's a top in this move. I can see the pace of the rise in QQQ is slowing. Just visually, anyone can see that. So I'm a bit worried now, you might say, and I think the market might get a sell-off. So what do? You could just sell TQQQ. You could just take your gains on that. You'd have had nice gains from down here. Nice smooth up move, good gains on that. And walk away, okay? And then wait for another setup. You could, having sold the TQQQ, buy SQQQ. Now, if you buy SQQQ here, let's say this is correct, and let's say the market falls here. And let's say the market falls in a very simple way, 1% per day for the next 5 days, let's say. So the QQQ will be down by 5%. Actually, it won't, will it? It'll be down by sort of 5%, dropping 1% on a compound manner each day for 5 days. But SQQQ will drop 3% each day, and then 3% the next day, and 3% per day for each of the 5 days. So that 3% will compound up for you. And in that way, you can make money on the downswing. Okay. If you didn't want to sell TQQQ, because if you felt that, well, this was a major market low, I think we're going to run to new all-time highs, I think this is just a temporary pullback, then you might do this. You might hold TQQQ, you might buy SQQQ in the same dollar amount that you hold TQQQ here. As the market falls, let's say it does, your TQQQ will go down, SQQQ will go up in more or less the same amount. It's not a perfect calculation, and Andy posted a fantastic article on this earlier, which I'll share with everybody that explains why that is. But roughly, the loss you see on TQQQ will roughly be offset by the gain you see on SQQQ, roughly. And let's say the market hit down here, it hit that wave 1 high over here, and you said, well, I think that's probably the end of the wave 4. I think what I'll do is I'll sell my SQQQ, I'll bank those gains. And if you're acute, you might go, well, I'll take that money. That's free money the market's given me on the way down, and I'll use it to buy a little bit more TQQQ using just the profit I've won here from SQQQ, just the free money, and thus adding to my TQQQ holdings to ride this final 5th wave up. Where point I might sell, or I might hold and rinse and repeat. That, in my opinion, is how to use the levered ETFs. You need to, 1, absolutely understand what it is you're buying, right? You are buying a highly complicated, highly complex levered financial instrument, right? If that doesn't set off big warning bells in your head, then do more homework, okay? Because this is not a free money pass, okay? This is a very complicated investment strategy. Number 2, read the fund documentation. Go to the fund manager's website and read all about the fund you own. If you don't want to do that, okay, but then you're in for a magical mystery tour because you won't know what you own. Next, think about risk management. At the most simple level, think about using a stop, a trailing stop maybe on the way up. Think about if you want to try to make money on the downswing as well as the upswing and using the inverse. And think about if you want to use hedged pairs to basically keep your account. Let's say, if you run the TQQQ up here, it's the only thing you owned. You've got profits up here. You added SQQQ down to here. Your account value would stay more or less the same. You sell the SQQQ, you buy more TQQQ with it, and then you've basically given yourself some free money, bought some TQQQ down here, and run it up here. That's not an easy strategy to execute, I can tell you. It takes a good few years of practice to get it right. If you do get it right, it's very, very powerful, but it's very tricky. And so if you want to do that, I would suggest you start by paper trading it. And I don't mean just dabbling with it. I mean seriously paper trade it, set up a separate account, treat it like it was real money, and learn how to get it right and how to get it wrong. It's not easy. And there are videos in this service, in the webinar list, that deal with hedging. And go and take a look at those if you're new here. They're pretty useful. And always ask away in chat. But in answer to, various people have said, I find these instruments difficult. They are difficult. They're very tricky. They're designed as daily instruments. They're not designed as, get rich quick things. You can turn them into very productive financial assets, but only if you learn how to use them. So that's a really quick overview. We've used TQQQ and QQQ as an example, but in the S&P world, SPY versus SPXL or UPRO on the long side, same story. SPXS or SPX, another one short one, but SOXS is another 3 times short. So that's equivalent to behavior in SQQQ. We talk about TLT on the bonds front. You can use TMF, that's a long 3x, TMV, a short 3x. There's equivalents in oil. In semiconductor, there's SOXL, which is a 3 times long, SOXS, 3 times short, and so on. But again, all of these things are highly complicated financial instruments, and I strongly recommend that if you are drawn to the return potential of them, and they can be tremendous, please do the work. Please do the work. Otherwise, they will hurt you badly. If you don't do the work, if you don't understand what you own, they will hurt you badly. Okay, that's it. Do we want to take some questions on that now before we move on to some other stuff? Hopefully, all that was clear. I changed mic, so I hope the mic was working okay.
Yeah,
Alex.
I have a.
Oh, sorry. No, go ahead.
That's all right. Go ahead.
I was just going to ask, just to make sure I understand. It sounds as though when you're talking about charting these, you are charting QQQ as an indicator for T triple Q. Is that correct, or are you charting T
Yeah,
triple Q itself?
I do. I don't know if that's what everybody does, but I find that easier. So I like to look at you could use the NASDAQ index, you could use NQ futures, but I use an unlevered instrument because the point at which the unlevered instrument peaks or troughs, that determines your sort of likely entry and exit points on those instruments. Yeah, I mean, I do look at the chart for the thing itself, but you can see that they're so gappy and they're fairly low volume that they're one, they're a bit difficult to use. Two, they don't trade very well to standard wave patterns, Fibonacci extensions, and retracements because the daily leverage messes it up. So me personally, yeah, I tend to. I mean, I would look at this chart, for instance. I mean, as you will have seen in trade disclosures this week, yesterday, there before, I forget which. I opened an SQQQ hedge for my TQQQ holding because I thought something like this might happen. It's options expiry tomorrow. That's going to be volatile, and so I just wanted to protect the gain in my TQQQ. And I did that. I judged that based on this QQQ chart, and I thought, well, QQQ, that's nearly a fairly chunky wave 3 high. It might go up there. I don't know if it will, so I want to protect my gain. So yes, I use the underlying. Yes, not everyone does, but I find that easier. Yes.
Okay, are you doing the same thing for SOXL? Are you using
Yeah.
SOXX? Because you've
Yes.
shown us some differences in the way that those charts looked, particularly with SOXL reaching the bottom and having that high volume level, which I followed you in, by the way, so I was really
Yeah.
happy with that. But
Oh, good.
but
Yeah.
you are looking at SOXX.
Yes. Yeah. No. So on the peaks and troughs analysis, yes. The thing that stood out to me on SOXL, hang on one second, was this. It's different. Okay, so let's look. Okay, this is SOXX, right? Unlevered. If we set the we set the volume clock here at, where is that? Okay, this is the middle of March. You know, there is a peak down here, but you can see there's sort of a lot of activity at all prices really. But SOXL, if you set the volume clock around the same time, there you go. There's this huge spike down here. You know, you can see that this volume zone, which is between, let me see, if we include that one, sort of $8 to $9.5 ish, $9.4, just outpaces everything. So I looked at that and I thought, well, that is a lot of buying. There's no way that's selling, institutional selling down there. That's a lot of buying down there. And that gave me confidence to add in, you know, in some size down here myself, which obviously has paid off, you know, well in the last couple of weeks. And so it's a reason why you should look at both charts. So the underlying chart would say to you, I think that's a reversal there. I think that C leg, you know, that's longer than the A leg. I don't know it handy, but that's probably about a 1.5 times A. That's a reasonable low. It looks like it's bouncing. I think I might buy there. But the thing that really gave me conviction to buy in size was this volume spike. That's all. But that's a lot of grown-up buyers buying down here. And why they're buying down here? Well, because the daily leverage has, you know, absolutely destroyed SOXL. You know, from a peak of $70 in July last year, it dropped to $7. It's almost a 90% drop, right? And it had fallen to the same level as the bear market lows and not very much far above the COVID lows. So if you just step back and you think, well, I know we've got some trade policy instability and all of that, but, you know, does the world for semiconductors really and truly look like it did in the depths of the COVID crisis, when no one knew if the economy could work or not, when no one knew if there was a supply chain or not? I mean, does it really look like that? I don't think it does. You know, I think there's a policy brouhaha that needs sorting out. And so for me, that was an easy load the boat sort of time. But I did so in the knowledge that I'm going to need to manage risk. And so, you know, we don't cover this live in this service, but in our inner circle service where we do, you know, I added SOXS 2 days ago because, you know, again, if you look at SOXX, look at it. That's peaking. That looks like a wave 3 peak. It's sort of struggling around this 200-day average. So it closed above it yesterday, just below it today by the looks of things. That looks like a wave 3 high to me. I think we're going to see some weakness next. Wouldn't surprise me if it retests the 50-day down here. That coincides with a wave 1 high here. So I'm sort of hedged 1-to-1 here, SOXL to SOXS, same dollar amount in both. So if SOXX declines, my SOXS will rise in value, SOXL will fall in roughly the same amount, not perfect, but roughly the same amount. And I would be looking to take profits on SOXS down here, you know, somewhere, roll that back into more SOXL, and then ride the final fifth wave up. And then for me, I intend to hold. I don't intend to sell SOXL when SOXX is up here. I think it's got more to run, but that's just my opinion. So you know, it's good practice to use both charts, but for the peaks and troughs and when to enter which side of the levered ETF pair, yeah, I use the underlying chart.
Great, thank you.
Great question, thank you. Paloma, you're on.
No, for the sake of time, I will pass.
Okay. Anyone else, folks, on this topic before we move on? Oh, hang on, I've got it written.
Alex?
Okay, Julius, let me just read this one out. So Julius says, is there a time of day that I like to buy levered or leveraged ETFs? What is the best time? No, I don't work like that. No, I don't work like that. I mean, my own view is people can tie themselves in knots about things like volatility, decay, fees. I mean, I personally, I'm not saying it doesn't matter, but I think that's immaterial compared to just being able to trade them successfully. So no, I mean, you wouldn't trade, you know, Nvidia stock a particular time of day. You just react to what was happening in price and volume at the time, and these things are no different. I don't think you can stress out about the daily calculations. You just have to know that you own a bucking bronco of an ETF. You have to know how to manage risk. That's it. You can't use math to work out where in the day you are and how many hours have passed and all of that. They're not that accurate, right? Remember, this is just a bunch of agreements between a bunch of banks to try and mimic what it would look like if it's an invented instrument. It's a bunch of banks that agree to say we'll do stuff that delivers, roughly 3 times that thing each day, roughly. And the reason the agreements between banks works is because the agreements are reversed on the inverses. Okay, so it's just money moving around between banks. Okay, it's not a real thing. You're not really buying any Microsoft here. It's just a completely fabricated thing. It's a game, and you're joining the video game, and the video game will hurt you if you don't know how to protect yourself in it. That's how I think about it. Prasad, you on?
Hi, Alex.
Hey.
So, question on. So you showed that there are swaps in those leveraged in ETFs, right? So
Yeah.
uh, the swaps also contain a time component for them, right? Like there is a time premium for them for those swaps, right? So my question is like when you hold SOXS and SOXL, right? And let's say the index doesn't move much, right? Then you're losing money on both sides, contrary to perception that if the stock right, like you're losing money. Shouldn't we treat them as like options having like a decay factor where they're constantly losing money? Unless there is a strong movement to offset it, you're actually losing money by holding them.
Yeah, you can think about it like that. I don't think about it like that, but yeah, yes, you can think about it like that. Yes.
Got it, got it.
My,
So
my own my own view, Prasad, is that people who are successful with these instruments, okay, learn how to trade them, okay, and I don't see anybody who's good at this stressing out about volatility decay, um, time decay, any of these things. They just go, okay, if market up, own the long. If market flat, hedge. If market down, own the short. Right? That's it. The people I see who are good at this are really simple with it. So you know that famous meme, right, where you've got the monk on the left hand side and the knucklehead on the right hand side, and the mid curve guy in the middle who's getting all stressed out about everything, and the monk is going, buy Nvidia, and the knucklehead's going buy Nvidia, and the guy in the middle is all stressed, going, but what about DeepSeek? But what about uh, teraflops this? But what about that? So my answer on this is don't be mid curve. Okay, you can be a monk or you can be a knucklehead, but keep it simple, right? Don't be mid curve. And I find that people who are not good at these things are mid curve. All the characteristics you say about the funds are absolutely correct, but success in making money with them doesn't lie in that analysis. Success comes in underlying analysis of analysis of the underlying instrument, spotting a market pivot, a wave too low to go long, a wave too high to go short, and calling that correctly. That's where success lies. And managing risk, okay, control risk. That's where success lies.
right, it totally makes sense, Alex. Like definitely, the timing the market and adjusting your positions has a greatest impact, right? The reason I bring about it is like I have this. I had can you bring up the NVDL symbol? Are you able to overlay like two symbols? On the same on the same thing,
Sure.
NVDL and NVDA.
Um, Hang on a minute. Do it easily on this.
Alex, I have to go. I'll listen tomorrow, okay, to the
Okay.
rest of
All
the
right.
leverage. The part is not my game, so
Okay. All right.
uh,
Thanks, Flo.
you're welcome. Take care.
All right. Talk to you soon.
Talk to you.
So, so can we, okay, so if we just do it to year to date, right? Just year to date, like, just want to zoom into the portion where like there was this deep seek sell off happened in Nvidia, right? So that's was like, 120, was it one as a percentage? Is it okay? So Nvidia is the orange one, right? Yeah.
Yeah.
So that's where like, so you can see that Nvidia. My position was like, I bought a lot of NVDL during the DeepSeek correction, right?
Mhm.
And now NVIDIA has more or less corrected, and not like around when NVIDIA was around 120, 121, right? Now
It's
NVIDIA is at like 133, right? So it's in the money, but my NVIDIA position is still, below
yeah.
my price, right?
Yep.
So, so it's a just question of 2 months, uh, right? And in this short span of time, like I am like, even though the stock has moved 10% more, about or 7-8% more than that, what the time I bought my ETF, I'm still underwater on the ETF,
Yeah,
right?
because look at what happened in April, right? So this is Nvidia here. It gets absolutely smacked by tariff gate, and NVDL gets smacked more. And so what happened is you get compounding, value destruction in the levered fund, and then to state the obvious, if your levered fund drops 50% in a week, then it's got to rise by 100% to get back to zero, to state the obvious. So
Mm-hmm.
that's going to happen, right? So that's why you can see just in this chart, it's a good question. If you don't NVIDIA year to date, you're flat. If you don't NVDL year to date, you're 20% down at this point, even though early on in the year in NVDL, you've been feeling very smug because you'd be 22% up with NVIDIA only, 10% up. So again, if you were going to own this, then you you either just play it for sort of short term in and out, or you learn to hedge it with NVD. No, NVD I think is the inverse, if I recall correctly. Yeah, there you go. But to your point, um, you know the both the long and the short inverses have lost money year to date, whereas Nvidia has been flat. So this is actually a really good example of why you have to know what you're doing, right? Because um, even if you'd owned both, okay, let's say you bought $1,000 of Nvidia, $1,000 of NVDL, and $1,000 of NVDS, sorry, of NVD. So both your long and short are out to the money this year, quite heavily so, but NVIDIA is flat. And so that's why you have to know what you're doing. Now, most people, I think, dabble with these things and they probably lose money. You really got to develop the skill. And the easiest way is, you know, buy during a deep dip. So if you bought during the deep seek sell-off and you sold a week later, you probably would have done great, right?
Right.
Um,
If I'd sold, I would have made some money. Correct. That's
yeah,
correct. Yeah.
yeah, that's it. And the trouble is you hold through a brutal sell-off of the unlevered underlying, and the levers are going to really kill you. Yeah.
Hmm. Got it. Got it. Uh, so I suppose like basically just if you're using these levered ETFs, strictly follow the charts and get out of these instruments when the charts turn. Right.
Yeah, I mean, more than it is not at all like owning a common stock. So if you're going to use them, you really got to control your risks. And so whether that's with a stop or with a hedge, or it doesn't matter. But you can't let them run away from you, because the compounding effect will kill you if you let it.
Right. Right. So what would you say is like a good stop loss, percentage when dealing with these levered ETFs?
I don't use stop losses on these. I hedge, so I can't answer that question. They are hellishly volatile.
Mm-hmm.
Nasdaq in the last week or so, we've had some 3 and 4% days in Nasdaq. That means TQQQ has been up by 10 and 12% some days, um, and it'll be down 10 and 12% some days as well. So I think it's awful hard to use that. I mean, you can use trailing stop, 15% behind or something. I don't know, but I don't use them like that. I hedge. I find it much easier personally. But it took me a couple of years to get good at it,
Got
and
it. Got it.
with a lot of practice and a lot of theory and a lot of thinking about it, it's hard. It's not easy at all.
S- Uh, and if you
I'm
look
going
at
to interrupt, Prasad. I'm going to stop you there because I've got other questions piling up.
sounds
So,
good. Thanks.
okay,
Thank you.
great questions, Prasad. Thank you. Athar, you're on again.
Hi, Alex.
No,
I didn't ask the question before, but I think that my question is kind of similar. But um, so, do you think this is more of like technical uh, thing, like you guys talking about? If the it's very sell off, you can just see the opportunity, you can buy, and then maybe short period of time trade, but you can still keep the regular com companies on the side or whatever.
yeah. I mean,
QQQ if you have it.
I mean that's how the fund managers market the funds. So again, if you were to read the TQQQ document, here you go, investment objective, daily investment results. Okay, so they are selling this to you as a day trading instrument. That's how the fund manager is marketing it. Okay, magnified gains will also magnify losses. So yes, you can use it if you think the market's at a low and you think, well, I'm going to jump in and jump out, basically a turbocharged swing trade, then they can be good for that. Yeah, but again, you have to understand your risk. Some people, and I'm one of them. Most of my accounts are in these things, right? And most of what I do is I put a lot of work into working out where the underlying indices are going to go. So the S&P and the Nasdaq in particular, also bonds for TLT. So I can think about TMF, oil for USO. So I can think about UCO, which is the 2 times long, or SCO, 2 times short. And I use these a lot, but that's after a lot of practice and experience, and quite a few punches in the face as well, from which I've had to recover. So, I mean, for instance, I didn't hedge enough on Liberation Day, right? So I was watching the market. The market was setting up for a nice sort of 1 up, 2 down, setting up for a nice run up on the Liberation Day announcement. If you look at the chart of that time, Liberation Day comes out. They start talking about 10% tariffs. The market goes, yippee, brilliant. And the NASDAQ jumps a point in post-market. So I think, brilliant, I'm all set here. Then they wheel out this reciprocal tariff board. And I look at it and think, well, that's obviously not going to happen because it couldn't happen. And the market for about an hour does the same thing, looks at it and goes, well, that's impractical, can't happen. And so I thought, oh, I'm not going to shake that off because that's obviously not going to happen. And we all know what happened. So basically I had to chase like Billio and hedge a bit late and scramble some short gains together, and then buy far more at the, buy a dip with much more gusto than I would prefer to do, in order to sort of scrabble back to where I should be, which is all worked out fine, but it was much more volatile than I would like. So it's not easy. And, there are people much better at it than I am, but I'm not bad. And I get punched in the face, a couple of times a year with these things. So you really have to take care if you're going to use them.
So just one more thing. If you are European or in the UK, there are funds for this. Obviously, you don't have TQQ, but they are similar. Do you have to go for hedge, like a currency hedged one, or you just go, or that's like more
Well,
another layer of complexity?
I'm in the UK, but I'm set up as a professional investor, so I can trade the US ETFs and I can trade leveraged ETFs. So
Or we
it
can't,
is,
like,
yeah. So if it's possible to set up that way, if you've got sufficient experience and all of that. There are downsides too. You have to sign away some of your MiFID protection rights, for instance. So if you're thinking about doing that, first thing I would do is go and consult a securities lawyer, because it's not without risk. There are UCITS ETFs that do this. So there's one called QQQ3, which is a London listed fund that's sort of a bit like TQQQ, and there's one called QQQS, which is sort of a bit like SQQQ. Again, it's a London listed fund. I find those hard work, really hard work. I've tried them, and because they trade London hours, not New York hours, you're always playing catch up, right? So the market's always moved a lot when they're not trading, and I find them really hard work, and I gave up in the end. It was too difficult. But have a look at them and see if they suit you. But I personally thought this is too hard.
All right, thank you.
Great questions, thank you. Prasad, you have another question?
No, Alex, I think it was just
Right, okay.
previous time. Yeah,
All right, Gene, you're on.
Yes, hi. Just a pretty basic question on terminology. You were saying you're not using stop losses, but you're hedging.
Yes.
So your definition of hedging in that context is you're basically holding the inverse ETF to offset losses or offset gains, whichever direction you're going, correct?
Correct. So to go back to this example here on SOXX, so I was furiously buying SOXL when SOXX was down here. Nice gains up here. I thought the market might be about to roll over. I want to protect those gains. I don't want to sell SOXL yet. I think it's got good upside ahead. And also because I want to, it's in a taxable account, and I prefer not to cash any taxable gains at this point. I prefer just to push the taxable gain off down into the future. And so I bought, I think 2 days ago, SOXS in an equal dollar amount. Okay, so that at that moment, I was perfectly one-to-one hedged. So if SOXX went up by a half point, I'd get 1.5% rise in my SOXL, 1.5% decline in SOXS, and they would offset each other. You get a bit of drift over the days for reasons we've talked about and other reasons, but broadly, it just puts I think about it as it suspends time in your account. Okay, it just puts a pin in your account value, and as the market ebbs and flows, you'll have changes in profit and loss on the long or the short side, but broadly they'll add up to no change. Now, if I'm right and this sells off, then what I would do is, when I think that the market's bottomed out, probably not. I'd be surprised if SOXX got down. I'm sorry, if SOXX got down to 186. But so let's say it dumps to 200 or something. I would sell the SOXS at this point. I would take the profit, just the profit, not the capital, just the profit, the free money the market's given me, and use that to buy more SOXL at this lower price here, and then ride it to the upside. So that's a form of compounding. It's a bit like dividend reinvestment in a common stock, where the stock spits free money out at you in the form of a dividend, and if you reinvest that in the stock, you basically get some compounding effect. Well, you can get that with hedging as well. So if in a bull market, if you have short profits, the market's basically gifted you some money, and if you take that profit and reinvest it along, it's a form of compounding. Again, it's tricky to do, but if you get good at it, it's a magic money machine. It can work really, really well.
So just one more follow-up question, Alex.
Yeah.
When you see and you're studying the more kind of complicated or complex or advanced hedging strategies out there, and they speak of net exposure, you're talking about that basically is talking about the difference between your long and short on net, correct? So if you're
Correct. Yeah.
exposed 50% to the upside, then you have 50% more of the long versus the short.
Yeah. So the way I think about that is, I might say, well, let's say I think the market's going to keep going up, but I'm a bit worried it's going to go down. I might be 2-to-1 long. So let's say I had 10 units of SOXL, I might buy 5 units of SOXS. Why? Because I think the market's going to sell off, but I don't have high conviction. If the market sells off, okay, my account will go down, but I'll have some profits in SOXS to realize if the market goes up, then because I'm net long, my account's going to go up. Not as fast as if I was completely unhedged, but it will go up.
And I'm sorry, just one last simple one. For those of us with taxable accounts, especially those who have like a tax efficiency mandate that we're trying to hit, if we're managing family money, et cetera. Is there anything simple with regard, like a simple strategy that we could employ while using these methods that could limit taxable gains, or that just comes with the territory? You're just going to have to set aside
Well,
X amount of
there,
dollars for the tax bill.
there is one way, which is sort of this. Okay, and forgive me for being a bit glib here, right? Which is, for all of history, stocks have only gone up. Okay, now forgive me, this is obviously a slightly stupid point, but you'll see what I mean. Let's say that you hit a major market low, March 2009 or March 2010, 20 or August 2024, or let's say, and I suspect that, I just think April the 7th, whatever it was, I think will be a major market low, I think. Let's say you said, well, I do think that's a low, and I think there's a great opportunity to own, a sizable allocation to, triple levered Nasdaq or triple levered S&P or something. And so I'm going to jump in, I'm going to buy that low, and I'm intending to hold that for the next 1, 3, 5, 10 years, a long time. Okay. And I'm going to make sure that I'm safe because I'm going to learn to hedge. And so when the market sells off, I'm going to hedge my position so that the brutal volatility that I know is coming because of the leverage, I'm going to protect myself against. Let's say you did that for 10 years. What would your taxable gains be? Your taxable gains would be your realized profits on the short leg. Okay. So every time you sold, for instance, S triple Q, if you sold successfully, you'd realize some taxable gains on that, but not much. And you'd be taking the profit to reinvest in T triple Q. And so you can be tax efficient with it, in my opinion. And this is not tax advice. Obviously you'll go and get your own tax advice, but you can be your tax strategy is don't sell the long, right? If you think that stocks mainly go up as long as you hold long for long enough, and as long as you can tolerate the volatility, and again, if you use the hedging strategy, of course you can handle the volatility, then your tax strategy is only take profit on the short leg, right? Just hold a long. And it's the ability to hedge that gives you the confidence and the fortitude, if you like, to hold along through volatility. Because if you learn to hedge, volatility isn't a problem. It's a fantastic opportunity. It is a way to just get the market to hand you free money. Now, again, I don't wish to be glib. It's not easy. But when you get good at it, when you cash short gains in a bull market and roll them back into the long side, I can tell you it is like magic internet money. It's tremendous, right? It's really tremendous. And when you get it wrong, and post-liberation day is a great example. I didn't hedge enough. Well, it's hard work, but these things aren't like options. They don't go to zero. If you were heavily long index calls, and Liberation Day comes along, that all those positions are going to go to zero pretty quickly. These things don't go to zero, So there's some way between common stocks and options like that, but they don't go to zero. And the ability to hedge means that you can turn volatility into opportunity. So my tax strategy on these things is, because I trade these in a taxable account, I try to never sell along if I can help it, right? That's what I try to do. Sometimes you have to, right? For the usual reasons, right? But I try to never sell along. I try to only liquidate short. Now, liquidation day comes along, and SOXL in particular became very painful, and I just wanted to reduce exposure. So I sold some SOXL. I took some losses on that, and I figured, well, at least that gives me a taxable loss when tax day comes around. Didn't much like doing it, but I thought, well, you've got to protect yourself at this point. And it's worked out quite well, but there was a lot of furious going on below the waterline to get it to work out. But net is your tax strategy is stocks mainly go up over time. If you only sell the short leg, you're cashing smaller profits, and you're delaying and deferring cashing out your long profit until such time as you think the market's hit a major top. Which could be tomorrow, I don't know, but probably isn't. Probably that's some years out.
Thank you very much, Alex. I appreciate that.
Okay, great question. Thank you, Gene.
Alex, just one small question on the same chart that you're seeing right now.
Yeah.
So SOXX, is it kind of top now? Is it time to kind of hedge on the other direction or sell SOXX?
Well, I can only tell you what I've done. Okay, so I'm 1-to-1 hedged more or less SOXL to SOXS, and the reason is because one, that looks like a wave 3 high to me, and two, because this 200 days troublesome, and three, because it's May OPEX tomorrow. Let's talk about that a little bit. So options expiry, we talk about that sometimes in the service, not very much, but let's just run through the very basics of it. Okay. Options, as you know, have fixed expiry dates, and there are monthly, daily in some stocks, but there are monthly and in particular quarterly expirations. The quarterlies are the big ones, but monthlies are sizable. So tomorrow is May options expiration. And this can induce some volatility in the market, but you can, to a degree, predict which way it will resolve short term, to a degree. So if you can get a sense of how are people positioned with their options, and there are people who will help you with this. So we partner with a company called Spot Gamma. I'll post a link to their stuff. They're really good on this stuff. Jay Abane runs an options service on our Slack platform. We do this work, we just don't do it in this service. So if you think that tomorrow it's likely that investors are heavily laden with calls, right? So the bounce off of the April 7 lows has been so dramatic that people have been buying a lot of calls. Now, what does that mean? Well, who do you buy the option from? You buy it from a market maker, from a dealer. So if you buy a call, you've made a bullish move. The dealer has sold you a call. Selling a call is a bearish move, obviously. Dealers don't make money from their positions, particularly they make money from a bid-ask spread. They try and hold a so-called delta neutral book, as in if the market changes in price, their overall book shouldn't change in value. Their money comes from the bid-ask spread, trading basically. So if dealers have sold you calls, that's a bearish thing to have done. Now, to maintain a hedged book, they have to hedge that with a long position. So they will typically buy either the underlying stocks. So let's say they've sold you S&P 500 calls. They'll typically either buy SPY ETF or often S&P 500 futures. Okay, so they've sold you a call. That's a short the S&P move. They'll offset that by being long the S&P. Now, expiry date comes along. Okay, all these calls either expire or they are exercised, right? And so the short side of the dealer's book, they've sold these calls, the short side starts to evaporate a day or two before OPEX, and it's all done by the close of OPEX day. Because the short side has evaporated, they're left with a longer side of their book. These are the futures and the stocks they've bought to offset that short side. Well, they don't want that. Remember, they don't make money from their positions, they make it from trading. So they've got to shed the long side. So they will sell the underlying. They'll sell the futures, they'll sell the stock. And so in a call-heavy OPEX, and you often see that when you see a big spike into an OPEX date, a monthly and in particular a quarterly, you'll see this again in June options expiry, you can often see some weakness afterwards, and that's because dealers are selling futures, they're selling the underlying, and that will cause some momentum downwards. In a put-heavy OPEX, in a very fearful environment, so Q1 2020 was like this, Q1 09 was like this, investors have been buying puts like there's no tomorrow because they're scared. Dealers have been selling puts. If you sell a put, that's a bullish thing to do. Dealers have had to hedge that. They've then shorted the index. Let's say they've sold S&P 500 futures. The puts expire, right? The bullish side of the book has evaporated. They've got to get rid of the short side of the book. How do they do that? They cover the shorts, they buy, right? And so in very fearful environments, like the COVID low, the GFC low, you often see V-shaped recovery. And the V-shaped recovery is basically catalyzed by dealer short covering, okay? And then that becomes momentum and everyone goes, oh my God, the market's going up, I've got to jump in on it. So the fact that it's OPEX tomorrow makes me want to hedge because I don't know how it's going to resolve. Sometimes OPEX is very quiet, nothing much happens. Sometimes the trend just continues. but often you do see a reversal, particularly in a call heavy environment. You often see, bullish to bearish reversal, and I just want to be hedged through that. Plus, which I've been busy the last couple of days, couldn't watch the screen all day long, so I like to be hedged in as well. So that's a very, very simple explanation of OPEX. It's much more complicated than that, but that's not a bad primer, and it's sort of the level at which I operate. I find that pretty helpful. So knowing when OPEX dates are, and the CBOE on their website publishes it. The big ones are the quarterlies, but the monthlies are important as well. If you know when those are, you can say, well, I think on the couple of days either side of this, I think things are going to be a bit volatile. So let's be careful around those dates. And again, not always. Sometimes it's plain sailing, but often you just see the market flying around a bit. And people use that volatility to take out both bullish and bearish positions. So you aren't really seeing real pricing around OPEX dates. You're seeing basically people trying to take out stops on purpose. So in general, know when OPEX is, be a bit careful around it, and if you can start to work out how are dealers positioned, what will their re-hedging flows look like, and what will that do to the market, that's really helpful. Again, you can find this out from us. We run a service called Jay's Options, and you can find it out from Spot Gamma. And I'll post a link to both things in the YouTube video to this later on.
Got it. Okay. Yeah. Thanks, Alex. This was a new thing. I didn't know about this option expiry effect.
Yeah, me neither. I learned it 2-3 years ago because I could see this weird behavior, and I didn't understand why. And I don't really trade options, so I took myself off to learn it, and I found that it gave me another sort of actionable angle to how to invest and trade. And nothing's perfect, nothing's infallible, but it's a pretty useful lens through which to look. So I would recommend people get into it.
Got it. Okay. So if that is the case, this would be the case. This would be the issue with all your other holdings also, right? Like QQQ or in individual stock holdings, they all could experience some downturn, right? For next, right? So is it better to deleverage a bit?
Potentially. So what when OPEX is coming up, what I would tend to do is I would expect some volatility. Now, of course, that doesn't mean it's going to go down. It just means it's going to be volatile. So that's the only thing I've learned, which is
Got it. Okay.
look,
But this SOXX charge it's kind of topping out anyway, right? So it's kind of at least better to just take some gains and just hold on for a bit, right?
well, my analysis, you got to do your own, of course. My analysis says, okay, look, that's a major market low. Okay, that's a righteous wave 2 low. It's between the 61.8 and 78.6. Okay, and it's a sort of a hammer candle. Okay, that's pretty obviously a wave 3. Look at the move, look at the power of it. It's shot up and through the 50-day moving average. It's not really making a very good job of getting through the 200. It's making heavy weather of that. It might move up over it. Who knows? Anything can happen tomorrow. But there's a lot of good news in semiconductor at the moment, and it can't make it up and over that 200. So that's a concern. And we are just shy of the 1.618 extension. So, that's a concern. And oh look down here, right? A wave 4, which usually doesn't go lower than the wave 1 high, that would sort of about touch the 50 days. So that would be a really neat sort of mess with everybody's head move. So I could be wrong, but I would say my opinion is that's a local top. I think we'll probably see some weakness. I don't think it's going to be terrible weakness. I think it'll be a moderate sell-off, and then I think we're going to see another move higher. So that's my guess. And a really simple one is that 200-day there. It is making heavy weather there. It's shot up through the 50, no problem. It's not doing that with the 200.
Got it. Okay, sounds good. Okay, and do we get GIP? Do we get alerts on SOXX and SOXL?
No, in the inner circle service, but not inner circle.
Got it. Okay,
Yeah.
Thank you, Alex.
Okay. All right, folks. Look, we're well over time, and we've only covered one topic really. So I know this is a topic that lots of people have questions on. I hope that it's been helpful. This is both levered ETFs and options expiry. These are complicated matters, but they're really, really worth getting to grips with if you're very serious about your investing and trading. But just don't assume they're easy. They're not. You know, if you want to make good money, that's never easy. It's difficult. Most people won't put the time in or the effort in or the understanding in. But these things aren't difficult if you slow it down and think about it and approach it in a calm manner. It's something that rewards work, patience, you know, thought, and just generally sort of not rushing in. So if these are things you want to get good at, you know, we can help you with your study and your work and your research. We can't tell you what to buy or sell. Obviously, that's up to you. But we cover this extensively here and in our other services. So good luck everyone that's trying to do this. And you know, please do always reach out with questions in chat on this stuff. I don't claim to be the world's best at this, but I'm okay at it. And if I don't know the answer to a question, I can usually find someone that does. So, okay, everyone, we'll finish up for the day. Recording will be live in a couple of hours, as always. I'm aware we didn't get to a lot of stuff, but this has been a popular questions. So this was a useful session. Okay, so a lot.